It's first quarter earnings seasons as companies release their key drivers of their performance. Hello and welcome to this week's episode of Africa Business Weekly. I'm your host, Akin Obakeye. South Africa is gearing up for a third budget after several back and forth with the proposed VAT increase. We'll be finding out more on the show today. And also in East Africa, we'll find out if firms can turn disruption into opportunity as the average US effective tariff jumps to more than 22% in just 4 months. Meanwhile, in Ghana, the gold brothers started operations as the country looks to turn the tide with its gold reserves. Now let's jump right into the show with content from Southern Africa. Karabo, it's over to you.
Very good evening to you, Akin, and to the viewers at home. So South Africa is gearing up for a third budget, and this is after the Western Cape High Court handed down a court order to suspend the VAT increase, which was due to take effect on May 1st. This brings to an end a dispute between the two largest parties in South Africa's coalition government over the revenue-raising measure. For more on what happens next with Budget 3.0, CNBC Africa's Nastasia Arendse spoke to Roy Haverman, who is a senior economist at the Bureau for Economic Research.
Now we know exactly what's going to happen, which is that nothing's going to happen. VAT is not going to go up on the 1st of May, as the Minister had previously said. I think it is the right decision. The courts were asking some very difficult questions about whether the Minister had the power to do it from a legal perspective without full support of Parliament in advance. And clearly, as we know, the parties were not clear. The political parties were indicating that they weren't going to support the minister's proposed increase, and so it wasn't clear that he would get a majority. What are the questions that I'm asking myself? Well, I think the questions I'm asking myself first is, when is Budget 3.0 going to happen? There are a number of processes that have to happen at the Treasury to make sure that the Treasury is ready to table a new budget. And the second one is, of course, what will be in it? As we saw from Budget 2.0 and Budget 1.0, the fundamental problem is that revenue is too little for the expenditure that we're getting. So spending is too high compared to revenue. And the Minister tried to increase revenue, and that was rejected. And so now really the point is, how do we reduce spending? And how do we reduce spending quite quickly to make sure the budget balances as far as possible?
I mean, you read that press statement that came in on Thursday night, early Friday morning from National Treasury, where they were indicating that obviously this proposed increase in VAT over the next 2 years will not be implemented. When you glean, that press statement, what do we know about exactly what will be in Budget 3.0, given the fact that the minister has already highlighted that this is going to have a massive hole when it comes to the medium-term expenditure?
Yes, well, I mean, I think what the minister said in that statement was quite clear in terms of saying that there are certain things that were increased because VAT was going up. And it's an odd thing to explain, but essentially, for example, there were above inflation increases in social grants to counteract the VAT increase, because obviously VAT is borne most by poor people and social grant recipients. The other thing that comes with that is the zero rating of goods. So a number of goods were zero rated. Between those two things, we're looking at somewhere between 6 and 8 billion in additional revenue, that additional fiscal space that the minister can create. And then the minister has been very clear that the budget needs to remain as prudent as possible, which I think is absolutely excellent. And so there are a number of things that could be done, for example, delaying some of the provisional allocations that were penciled in. These will probably only be able to come into effect, in any case, quite late in the financial year, because with all the delays now, the first time that the Division of Revenue Act and Appropriations Act can be passed is probably closer to September, and that means that these additional expenditure items will only be half as big as they were previously, because it'll only be 6 months of the financial year. So there are a number of ways that the minister can make sure that the budget is still prudent, given what has happened.
We've never been here before, and a lot of questions have been moving around when it comes to the credibility or perhaps even the risks of Budget 3.0. Where do we stand when it comes to the risk of a budget 3.0? Are there any risks, and what does it mean then from a credibility point of view?
Yeah, well, the problem is a lot has happened since budget 2.0, and even more has happened since budget 1.0. Naturally, in the US, tariffs have been increased by Donald Trump. This won't affect our trade directly, but it will affect many of our trading partners. It'll affect some of our trade, but it'll affect many of our trading partners. And so our economic growth is probably going to be a lot lower. The BER has revised our growth forecast down to 1.5%. The Reserve Bank has their growth forecast at 1.7%. And the IMF is even lower than that. They've got growth at 1% in this year. At the same time, inflation figures came in a lot lower than a lot of people expected, in part because the economy is growing very slowly at the moment.
The United Nations Global Compact, which is the world's largest corporate sustainability initiative, earlier this week hosted a forum in Cape Town, South Africa. The meetings took place against a backdrop of heightened geopolitical fragmentation, where stringent protectionist policies, most notably from the US, risk upending the multilateral order. For more on this year's UNGC forum, CNBC Africa's Fifi Peters spoke to Sanda Ojiambo, who is the Assistant Secretary General of the United Nations Global Compact. Let's listen in.
We're a global organization headquartered in New York, part of the UN system, but we uniquely work with businesses and around a corporate sustainability mandate. Look, what we're hearing from businesses is that there is, yes, in a segment of the community, dialing back on key issues, pressures on issues such as DEI, climate action, inclusivity, and others. But at the same time, business leaders are also saying, and we've heard that a lot from South African businesses, that it is so important to keep the eye on the long term and to make sure that issues such as inclusive business, favorable and equal trade opportunities still exist. And so it's a little bit of both messages. I think what we're hearing is business has been impacted. They're challenged because things such as DEI, economic empowerment, inclusive business, climate action are so important to business. That has been proven for a long time. And what we're seeing is a period of uncertainty and a period of adjustment. But at the same time, we hear from our business membership that it is important to keep the eye on the long term. And so it's that balance of short-term imperatives versus long-term sustainability that is so important at this moment in time.
Sure. And how are business relations amongst members, would you say? I mean, how different do they look from what we are seeing politically with the standoff between the key nations? And whether, I suppose the question is whether the standoff or the political friction is being reflected in how the entities are relating amongst themselves in the boardroom.
Yeah. Well, look, obviously politics is vastly impacting the multilateral system. It is under strain. International cooperation is going into frontiers where we've never really seen it before in terms of the fragmentation that we see. And it does impact business because business needs to trade across borders. It needs goods and services to move across the board. Businesses have their supply chains, their inputs, their labor, all across the world if you're talking about a multinational. So obviously at this point in time, the political environment is definitely impacting the business environment. Business too needs the stable cooperative international system to function. Markets, trade, investments, exchanges, they all rely on a stable multilateral system. So there is a lot of flux and there is a lot in change. I think why the multilateral system is also so important is also because collectively we get to tackle things like climate change, pandemics, AI governance, so important. So the fracturing of the multilateral and the political system is impacting business. Look, we sit at the UN, and for us, it's so important to reinforce the need for a strong multilateral system. And what we hear from businesses and CEOs here too is that it is important as well. It provides safeguards. It almost de-risks the environment around which they trade, they source inputs, they source labor, and around which they create markets. So it is important. We cannot at this stage definitely say that the politics is not impacting business. The two are highly, highly intertwined at this point in time.
Those were the stories driving the southern tip of the continent. You can, of course, revisit these stories on our website on CNBCAfrica.com. But for now, it's back to you, Akeem.
Thanks, Karabo. East Africa is still in the euphoria of the Workers' Day celebration, so I'll be standing in for my colleagues in Rwanda. The International Monetary Fund recently revised growth forecast for Africa to 3.8% for 2025 in the latest regional economic outlook, which may weigh down economic activity on the continent as long-term growth remains blurry. CNBC Africa's Abi Agina had an exclusive interview with Kati Patilo, IMF Deputy Director for Africa. Take a listen.
We're here in Tanzania to launch the IMF's regional economic outlook for sub-Saharan Africa. Every 6 months, we release a regional economic outlook, and we launch in different countries in the region so that we can engage with wide range of stakeholders, government, civil society organizations, private sector, business organizations, universities, to share perspectives and hear about all people's views of what's going on in their country and the region.
Amazing. And just recently we did see the regional economic outlook being released by the Africa Department, and some interesting numbers and interesting policy prescriptions for Africa. And just speaking of there, we're seeing growth will be moderated about 3.8%. And I just want to get your thoughts in terms of what does this mean for the economies going forward in Africa, and at the same time, what are some of the outliers in terms of the countries you're seeing taking very proactive measures in ensuring that there's fiscal prudency?
So indeed, what we're seeing now is that what had been a very hard-won recovery in the region is facing another huge test in the face of this surge in global policy uncertainty that's putting a real concern for the region's economic outlook. And so while policy efforts were just starting to bear fruit last year with growth exceeding expectations, then at the beginning of this year, we have the global shock of this realignment of policy priorities that has led to a downgrading of our expectations of growth for 2025 to 3.8% and for 2026 to 4.2%. And that relates to the impact of the tighter global financial conditions, the softer commodity prices, and the softer global demand. We're seeing then differences across countries. What we had seen for some time is divergence between the growth of the more diversified economies, which were doing better, and the more resource intensive. And so we continue to see then that divergence, and with the oil prices falling, concerns of risks for how that would affect large oil exporting economies. The picture is quite mixed, though, because there are pockets of resilience also. And we have, out of all the 20 fastest growing countries in the world, 11 of them are in sub-Saharan Africa for 2025. So even in the face of headwinds, there are countries that are demonstrating resilience and need to continue being resilient.
In just 4 months, the average U.S. effective tariff has vaulted from about 2% to more than 22%, the steepest jump in over 100 years, tightening already thin margins for East Africa's coffee, tea, apparel, and other light manufacturing exports, with the World Trade Organization warning that the new tariff wave could dip global goods trade into a slight 0.2% contraction next year. The big question is, if East African firms can turn disruptions into opportunity. CNBC Africa's Ridima Shukla spoke to Stephen Ruzibiza, Chief Executive, Rwanda Private Sector Federation, for more. Take a listen.
There are some steps which have been taken for purposes of diversifying the current export products, but also facilitating the export processes. From Rwanda now, instead of having multiple export licenses, they have been condensed into one export license for multiple products. If you may have seen, to access the CFTA markets in Ghana, recently Rwanda exported a number of products under one export license. Two, domestically, export license and import licenses that were acquired from FDA and RICA in Rwanda have been eased for purposes of trade and business people to access and facilitate them to get the services without hardships. Of recent, the Minister of Trade passed that directive and has somehow helped the business operators to do their businesses with less difficulties.
That's brilliant. So this is clearly a reflection of how this is changing and a reflection of the support that firms are going to need to actually ensure that they can convert curiosity into purchase orders. But how realistically are you seeing, what are the new markets that are realistically interested and are possible?
The markets have been there before, but people have been choosing these other markets because of different reasons.
Right.
One, it has been the preferences of the product. Normally, you change the markets depending on a number of factors. But today, if you use only African markets, it can accommodate some of your surpluses that have been affected by the tariffs that are going on globally. Asian countries, there are Asian countries, Middle East countries that are coming up, and the business operators, with the help of the government and us private sector, we are trying to find out which markets can take up these products.
Right. So GCC and Asia has been added into the new hub for hub of demand. But looking how logistics have existed all this time with a different kind of demand hub, how can exporters, how can the private sector ensure that they can sustain the margins that they've had so far and in fact increase them? And does that require tweaks within the AFCFTA policy and as well as developing the logistics value chain in Africa?
Logistics is a very component impact in terms of infrastructure. Globally, even before we talk about the CFTA and ESG levels, they have been some incentive to do the port developments, because at least you need warehouses, storage facilities that can accommodate the products for a long-term use. Because of the disruptions that are coming up now, nobody expected this kind of dynamic change quickly. So now the ongoing process of programs is to see how best we open up new routes. You have seen in the West Africa, Angola, DRC, the current existing Northern Corridor and the Central Corridor that supply the East African countries. Trade barriers have been addressed to see how best some of these hindrances can be reduced. But also we have to develop infrastructure in terms of cargo transport. Rwanda has acquired, for example, the cargo plane. So all these are coming in to help the logistic elements that has increased even before the tariffs came in, especially during COVID period.
And looking at these new possible trade corridors, what effect can be expected on the margins that exist today and that have already been squeezed by the US tariffs?
For a short-term period, tariffs the margins are likely to reduce because people are going to be looking at policy strategies of how best to mitigate all these disruptions. Therefore, for a short-term period, the margins are likely to grow.
And in West Africa, Ghana says it will prosecute any individual or entity found trading gold without a gold board issued license. Now, this directive took effect on the 1st of this month, with the gold board beginning operations this week. Nere Miko, vice chairman at Ken Smith Refinery, discussed the developments and the outlook for Ghana's gold production. Take a listen.
I have to say all eyes are on Ghana. It was, on one hand, short news, but on the ground, the people of Ghana are rejoicing. They're optimistic. Well, I'll tell you what's significant about this. about 61% of the export license for gold are foreign entities. So this is actually very significant. However, just so you know, foreign entities could still buy gold. They just have to come licensed with the gold board and be maybe a licensed off-taker or buyer. So on one hand, significant, but the other hand, they haven't totally been left out of that play.
Now, as far as this gold board is concerned, obviously the country is trying to increase its gold reserves. Latest numbers that we have from as at April, somewhere at 31.01 tons as of April this year. And we also know that the Gold Board has signed a deal with 9 large-scale mining companies to buy 20% of their local gold output. Talk to us about, what the government is doing with this and what the big picture is for the Gold Board.
So to give you a perspective of what's happening, I think the Gold Board has observed the buying market. So the government buying program has been running a few years. They had about 10 tons in 2023 that they got, and now they're sitting at just a little over 30 tons. So right now, you are having Ghana having gold be about just a little over 41% of its international reserves. And Ghana is now top 5. Libya, Algeria, Egypt, South Africa, and Ghana. So Ghana is looking now to say, well, how do we place and increase these reserves? They've looked at their gold production output. You have about 4.6 million ounces that Ghana is producing. The small-scale artisanal production is 35% of that, which is about 1.6 million ounces a year. This is about 503 tons a year, sitting at about 42 tons a month. So if you look at what the Ghana Gold Board is trying to do, they're looking and saying, okay, fine, the government has said they'll capitalize 279 million into the Gold Board, and the Ministry of Finance says they'll provide $250 million of liquidity buying gold for buying gold each week. This is about 3 tons of gold that the government is looking to mop up. We're not quite sure exactly how much of this will go to the reserve. Let's assume what the ministry is providing, Ministry of Finance is going. So we're looking at least 12 tons a month is what the Ministry of Finance is trying to do. So looking at the numbers, clearly the government of Ghana has thought this through. It looks very good. They have really carried stakeholders along, and this is why you have those 9 major companies, because they've engaged the chambers of mine, the stakeholders, to give input and to let them know their vision, and the people are buying into the vision. So this is the plan. You could look at the numbers and you can see very quickly what they're trying to capitalize on, and they're looking and saying if they can grab, let's say, at least 70% of the artisanal production, this would be a real game changer for Ghana and really change the outcome of, should I say, gold production and the value chain for Africa.
Meanwhile, Moody's believes the U.S. import tariff are credit negative for African banks, but risks should be manageable. Now, the rating firms expect the U.S. Federal Reserve to hold rates steady for now, but cut rates later this year, which will lead to global monetary easing. However, heightened financial market volatility and investor risk aversion will likely widen bond spreads or increase credit differentiation for African banks. Mikabia, Senior Vice President, Analyst at Moody's, joined us earlier for this.
We believe that the US tariffs are credit negatives for African banks, but that the risk should be manageable. So after the 90-day pause is lifted, if the tariffs are implemented, we believe that the direct credit implications of tariffs for African banks should be relatively limited. And this is because trade between the African continent and the US is relatively limited. So there's limited implication for tariffs on a direct basis. However, we believe that there will be some noticeable indirect implications for African banks, and those implications will primarily show up through 2 different channels. One is the macroeconomic fallout of the tariffs globally and on the continent. And the second one is the implication through the financial markets channel.
Right, and overall this year, forecasts we've been seeing from the IMF and just today from the World Bank, from its commodity outlook, the global growth is expected to be a lot more fragile in 2025. Now, you say that you also share that opinion, that reduced economic growth, but you say that this could negatively affect African banks' profitability and even asset quality. Could you share some more insight, elaborate further on that point for us?
Sure. So our overall outlook for African banks isn't changed. However, we believe that the tariffs will and then engender a more challenging macroeconomic outlook for the banks. So, if tariffs are implemented after the 90-day pause, they will lead to significantly lower global economic growth, and that also then in turn means lower economic growth for the African continent. The implication then for banks, as you said, is that that would weigh on the amount of business they generate, so that weighs on profitability. That will also affect the repayment capacity of their borrowers. Will find it more difficult to repay their obligation amid an environment where economic growth and business activity is lower. So we think that even if the outlook for African banks isn't changed, there will be some challenges that they will face given that macroeconomic fallout that I just referred to.
And speaking of challenges, the report also does mention China, African banks and their business with China. You say that obviously we're all expecting a slower growth in China this year, and you say that this could modestly weigh on the bank's ability to generate a new business. Could you help us better understand that?
Yeah, so this is one of the other ways in which the implication of the macroeconomic fallout globally do affect the banks in Africa. So in indirect ways I was mentioning earlier. China, as you know, is a primary market for commodity exporters in sub-Saharan Africa. So it's a very important market. So as tariffs weigh on economic growth in China, they are likely to also affect the amount of exports that African exporters are able to do with China. That then will have implications for the banks because it just mean lower business opportunity in terms of trade-related business that they can generate with their clients. So China is another, lower economic growth in China is another potential transmission channel for African.
And that's all in this episode. You can catch all the latest stories across the continent on our website at cnbcafrica.com. Thank you for joining us on Africa Business Weekly. Until next time, stay informed and stay ahead. I'm Akin Opakeye.